Alright guys, welcome back to another video on the channel, and today we're going to be going over a few slides before we dive into a breakdown trade of one of the trades we actually took this week. It didn't hit final TP, nor did it hit second TP, however it was the correct analysis, and during actual good seasonal tendencies, price would have actually ran all the way to final TP. So I'm going to break down that trade shortly after going through a few of these slides as well. So going over the first slide, we're talking about and discussing the unicorn model. It's the setup which we trade day in and day out, extremely high probability, and monitoring price, say inside of any of the macros such as the first AM, the second AM, or even the final PM macro. We usually look for price to draw up once swept major buy side liquidity. We'd look for the original sweep of buy side liquidity to then get taken out again. So such as this short term high you can see here has then been taken out after it's taken out this minor buy side liquidity. So let's say, for example, we have major buy side liquidity resting at this level here, and this is the first sweep of buy side, and then price came back up. There's buy stops resting above this level here, and you would anticipate on either NQ or ES, so it doesn't matter which pair actually sweeps it, it would create an SMT, but we'd look for a sweep of that short-term high on either NQ or ES. And then after that sweep of buy stops of that short-term high, whether you're looking for longs or shorts, that short-term low or short-term high, vice versa, considering that we are in a premium on, say, the 15-minute or higher time frame, and we've tapped in and filled a higher time frame bearish imbalance resting above buy side liquidity after taking out that short-term high inside of the macro of, say, let's do it for this YouTube video example of the 9:45 AM to 10:15 AM macro, which is the first AM macro. Personally, I would say it's the most high probability as it's the most volatile macro out of all of them. You would anticipate a sharp displacement below that previous short-term low where price sharply displaced, and then offer you some sort of entry off a breaker block, order block, a bearish gap, so on and so forth. And you can see here, let's say for example we have this bearish gap. You look for an entry as soon as price comes in and taps that bearish gap. As soon as you get a tap off that gap, as long as price offers you a clean risk to reward and also a valid stop placement with your stop not being greater than 25 handles, you would enter off a tap on that bearish gap and target the opposing liquidity, such as London lows or relatively equal lows for around 100 or 150 handles. We run our first DPs at around 25 handles, or if you're going short, it will be a previous short-term low or minor sell side liquidity. After the first DP, you would actually trail your stops to that previous short-term high, or you could trail it to actually break even depending on the conditions and whether that is actually a valid point to trail your stops to. At second TP, which is resting around 50 handles, or say a 62% or 50% retracement for price at more of a major buy side liquidity, you would actually trail your stops two short-term highs behind, or most likely leaving it just at break even at this point in time, and you close out a further 20%. So at around second TP, you're around 70% closed out of your position with your stops trailed in a profit around two short-term highs behind, and at final TP, opposing liquidity such as London lows, you'd be fully closed out. Now let's dive into the next slide, talking about macro times. So which sessions do we trade and which ones are the most high probability? So the three macros which we actually trade is the 9:45 AM to 10:15 AM macro. That's the first AM which we always monitor. Then the second AM macro runs from 10:45 AM to 11:15 AM. And then you have the PM session which runs from 1:45 PM to 2:15 PM. And there is conditions such as Monday with no red folder news. We wouldn't even bother monitoring the PM session, especially if we've already caught a W inside of any of the macros. This applies to any day of the week. After a W, it doesn't matter whether it's only 25 handles or if it's 150 handles. You'd be done for the day and you approach price the next day. For example, if you was to take a loss inside of that first day in macro, then you have one more opportunity with half position size to look for a high probability trade setup inside of, say, the second day in macro, or possibly the PM, depending if it is after Wednesday or it's a Tuesday or a Monday with red folder news. If it's a Monday with red folder news, you can take a look at the PM session, but you have to be very cautious and only looking for high probability trade setups only. Which session has the highest probability? I would give it to the 9:45 a.m. 10:15 a.m. macro. There's a high amounts of volatility and it's the macro that I prefer to trade the most. We don't personally trade the London session between 3 a.m. and 4 a.m. I don't like trading the London session. That's why we only stick to 3 macros only. And then you have the New York lunch, which is not a macro that anyone should trade, but New York lunch runs from 12 p.m. to 1 p.m. New York local time. And between these times, ready for the PM macro, you mark out lunch highs and lunch lows. So the highs made inside of lunch and the lows made inside of the lunch, you would actually mark these out, and these would be major draws on liquidity for the PM session. Not every single time approaching price inside of the PM would you actually get these major key draws on liquidity, but they are key levels to actually mark out. How do you approach price inside of a macro which contains high impact news? So this is a very straightforward, direct answer. So with 10 a.m. news, there's two scenarios. It's either going to be manipulation or displacement. For example, PMI, let's say a PMI red folder news event comes out at 10 a.m. Then it's either going to manipulate and take out some sort of short-term low, short-term high, buy side or sell side liquidity. And then after that, you would have around 15 minutes left of that macro side of the first AM to actually see that sharp displacement higher or lower, depending you're going long or short. And then you can actually take a trade to target the opposing liquidity. Or it's going to cause, after manipulation has already happened inside of that first AM macro, the 10 a.m. news will actually cause the displacement for price, which you can then actually engage with and take that as a clean setup to go long or short. That displacement at 10 a.m. news obviously can't be greater than like 50 handles or 100 handles, because then the fair value gap is going to be huge and the stop placement won't be valid. So make sure your stop placement is valid in that scenario that 10 a.m. news causes the displacement. Another one which I'll be quick to mention is about, should I trade if I see a clean setup outside of macro, even if it's 1 to 5 minutes outside of macro? Should I enter? The answer is no. It's a very simple answer. You do not trade outside of macro. So let's dive straight into the next slide. Next slide we're going over is risk management. Very important slide. And inside of our group, inside of ICT Bibles, one of the groups that people get access to once they do join, it contains a lot of information based on psychology and risk management, as a full risk management plan which is just being created around 2 days ago for Apex, Top Step and FTMO, and every single account size, how many contracts or micros or even the dollar amount you should be trading or risking per trade. And also there's also a risk management plan for the scaling up of each one of the accounts as well. So once you actually get funded, instead of trading the basic risk management for say a 150k account of 15 micros, you can actually scale that 150k account up to where you're trading 4 full NQ contracts with the correct drawdown. You should never take more than 1 to 2 trades a day. If that first trade is a winning trade, you're done for the day. If not, you can actually approach one of the next macros with half position size, looking for A+ setups only, as we've already gone over. And then also understanding the mental side of trading. A lot of people struggle to understand how I've developed the level of patience which I have developed. We go many days and even half a week, or sometimes even the whole week, without taking any trades, and people are sat there going bored out of their minds, losing themselves a little bit because they can't believe that I haven't taken a trade in a whole week. But if you're not comfortable with engaging with low probability price action and you don't feel comfortable taking that trade, then don't take it, because it's only going to be soon enough where a high probability trade setup is going to present itself. So why engage with low probability price action when you know in the near future you're going to get high probability price action? Developing patience, discipline, and avoid revenge trading at all costs. People say, how do you move past this? How do you stop revenge trading and basically gambling your account away? It's very simple. Everyone already knows the answer to this. It's a stupid question to ask. It's very simple. You just do not do it. It's one of those things that everyone knows the answer to. Just do not do it. Stick to your rules and you're going to get paid out within a time frame of a month or two. Not like these other influencers who may claim that you can get a payout within a week or two. It's unrealistic. It's going to take you around a month to get funded and a month to get paid out. Stick to your rules and you're going to be getting paid. You'll build your capital up over the course of 6 months. You should be fully funded on all prop firms within a 6-month period, considering you're taking your own trades and you're completely profitable, or whether you're taking my trades. Then you can actually expect that within around 2 to 3 months. Obviously, seasonal tendencies do play a massive factor into whether you're withdrawing every single week or once a month or twice a month. It completely depends on price action, but this whole year there is an Excel sheet and we've not had a losing month this whole year. Even on slow months, they are still big months. Many traders are already profitable, however they just cannot control their emotions, and on a rainy day they will go all in or try pick the fast route, which is the slow route, and the slow route of actually following your rules and the correct risk management, which you may think is taking forever, is actually the fast route to getting funded, paid out, and building your capital over a period of time. And as you already know, first TP ran at around 25 handles, you close 50 to 60%, and then you move your stops to that previous swing high or low, whether you're long or short. Second TP around 50 handles for a retracement, and then final TP at the opposing liquidity for around usually 100 handles, or sometimes we've actually ran trades all the way to 170 handles, depending on the price action. For example, if you have a 150k top step account, you can actually trade using, I would actually recommend 12 micros, and when you get funded and build up a buffer, you can trade with 15 micros, which we'd be risking on a 25 handle risk, $750 per trade, and you'd only look for at least a 1 to 2 or a 1 to 3 risk reward or better, therefore aiming for around 1.7k per account with top step, and you can have 5 150k top step accounts. Therefore you're making around 8k a day. You only be able to withdraw around 50% within the first 30 days of having the account, but after that Top Step actually allows you to withdraw 100%. So let's dive into the next slide. Understanding sweeps of liquidity and when you should actually look for clean sweeps of liquidity. So identifying major sweeps of liquidity around the time of 8:30. This is an algorithmic sweep that can determine a bias for the New York AM session. Not always will there be a obvious sweep at 8:30 AM, but most of the time, majority of the time, there will be a major sweep of a major sell side or buy side liquidity around 8:30, which will then determine the bias for longs or shorts for that session. As you guys already know, and people who follow me for quite a while now, you already know that majority of the time we run a neutral bias looking open for both longs and shorts. The reason for this is because sometimes when you're so caught up looking for longs, you'll miss the cleanest setup for shorts. And when you're so caught up looking for shorts, you'll miss the clean setup looking for longs. That's why it's good to have an open bias. But at the same time, if London lows have been swept and you're in a discount, filling a 4-hour higher time frame bullish imbalance, resting below London lows, you're going to be running a bullish bias 100%. But then at the same time, you need to think, okay, this has happened. But if prior to the macro, price actually retraces back and takes out some sort of major buy side liquidity, then you can't still be open looking for longs. You need to switch your bias and look for shorts. So that's why it's good to have an open mind of open to switching your overall bias depending on what price action is actually offering. To mark out major buy side and sell side liquidity using the 15-minute to 4-hour time frame depending on your screen size basically, and you want to mark out them key levels prior to any of the macros such as the New York AM macro or the PM session. For the New York AM session, you want to mark out London highs and lows if you can. There's not always presented. Between 2 AM and 5 AM is the London session, and you want to mark out the highs and lows inside of that period. And now we've gone over liquidity. Let's dive into the next slide. Which prop firms do I recommend? There's 3 prop firms that I can recommend, and 2 which 100% certain is that Top Step is the #1 futures prop firm. I am not affiliated with them, and I'm not going to make any money from saying this, and neither do I want to anyway, but I'm telling you guys, I've never had an issue with Top Step. They pay out the same day, or usually it would be literally the next day. Top Step always pay out within 1 to 2 working days, and it'll be in your Wise account or bank account. FTMO 100%. I recommend them. Never had an issue. Similar to Top Step, they pay out very, very fast. FTMO accounts can cost a little bit more than other prop firm accounts, but once you do have an FTMO account, they are extremely hard to lose due to the greater size of the drawdown on each account. Apex is good. You can acquire a lot of funding with Apex. I've had a few issues in the past regarding payouts and also them claiming that I'm actually below the 30% rule, which I'm not. However, I'll let it slide, and I'm also going to keep you guys updated about that payout I submit on the 1st to the 5th of November, which is the next payout period for Apex. However, I do recommend them, and I have since that issue received multiple payouts on my 300k accounts. And now let's dive into the next slide. A few takeaway notes that you guys might want to screenshot if you're new to ICT, but we never trade any sort of pattern setup. You should never trade using based off indicators. Anything to do with indicators should not be on your chart at all. Anything to do with moving averages or any of that bullshit, you should not have it on your chart at any time. We look for longs where retail sells, and for example, this should be in a discount and this should be a premium. These two need to switch over. But we look for longs once price is in a premium and obviously a sweep of major sell side liquidity. For example, I will show you guys a clean trade setup that we actually took this week live, which you can also refer back to on this channel. I did post a live stream for that trade, which I'm about to break down as well on the channel, so you guys can see me take that live. And then after you take that trade, you anticipate price seeking the opposing liquidity. For example, you would target London highs or relatively equal highs if you're going long. And then always, it doesn't matter if you see the cleanest setup of your life, but time comes before price in all cases. So now we've gone over the PowerPoint. I hope I've explained this well and you guys have a better understanding of what we look for when approaching price into each macro. And now we're going to get into a full breakdown trade of one of the trades we took from last week. Alright guys, welcome to the breakdown trade, which is one of the trades we took last week on Wednesday on the 23rd of October inside of the second AM macro. And approaching price, obviously you want to monitor both NQ and ES simultaneously, looking for correlation between the two pairs and SMTs. What I mean by correlation, when you approach price, you actually want to see price correlated between the two pairs where both NQ and ES has taken the same levels around the same time. The only difference that we look for, which is also another confluence, say ES was to take that short-term high but NQ didn't, and then we've seen a sharp displacement on both pairs, that'll be a confluence of an SMT. So approaching price prior to the macro of this second day macro, you can see I've just marked out the macro window of 10:45 AM to 11:15. That is where we look for our entries for price. And prior to the macro, I marked out this level of minor buy side liquidity on both NQ and ES, and we caught this trade live. So if you guys want to refer back to the YouTube channel and actually watch me take this live, we took this live. We only secured first TP on this trade. We have a clean pair of relative equal lows resting at 345. We have this level of minor buy side liquidity, and now let's see and monitor price prior to the second day macro to see whether these two levels get taken out as prices retrace back to a premium, and then we can look to target the opposing liquidity of these relative equal lows. So as you can see here, we've just entered inside of the macro. This previous short-term high has just been taken out, and we've also swept this minor buy-side liquidity. At this point in time, we would anticipate a sharp displacement lower below this previous short-term low after price has actually swept buy stops at this key level. So now let's anticipate a sharp displacement lower, and you can see here I'm unable to replay the chart for ES, but you can see here that ES has actually swept that minor buy side liquidity as well. So it's both correlated between the two pairs as of now. So now we'd anticipate that sharp displacement lower. Okay, so price is sharply displaced lower on both NQ and ES would actually, this is the displacement level that you would look to monitor for ES, which is that previous short-term low. So ES has displaced and so has NQ. So we'd actually look to take this upper 1 minute bearish gap. However, I believe price didn't actually give us an entry on this one, and we took the lower bearish gap. So you can see here, price created a lower bearish gap and didn't give us an entry on that upper one. And ICT says himself, you always take the first bearish gap which is offered as long as it offers a valid stop placement as well. So now let's see whether we catch an entry off this bearish gap. And there you go. So as you can see here, price gave us an entry off a tap on that bearish gap. We ran around a 22.5 handle stop, and we targeted the opposing liquidity, offering us a 1 to 3.2 risk to reward in this trade, aiming for around 72 handles for them relative equal lows. Our first TP was at 25 points, and in this instance, because this trade is only around 70 to 72 handles, we did not run a second TP. You could have ran a second TP around this level here, but we just ran a first TP at 25 points, which is around a 62% retracement of this move, and then our final TP aiming for around 72 handles at these relative equal lows. So let's see how this trade plays out. So as you can see here, our first TP got hit. We closed out 50% of our position and moved our stops to break even. Therefore, it's risk-free on this trade, and we've secured around 25 handles on this trade so far. And there you have it. So price came back to break even. I'll keep the charts playing, but you'll see shortly after what actually happened after it took us out at break even. And there you go, it went all the way to final TP. And not all of the time are you going to get your stop placement and moving your stop back to break even correct, because no one is perfect at the end of the day. We secured 25 points in this trade and moved our stops to break even. Price came back literally by a couple ticks, took us out back at break even, and then it ran all the way to final TP. But this is just a clear example of what we look for in price whilst approaching a macro. A clean sweep of a minor or major buy side liquidity, short-term high and buy stop swept, extremely sharp displacement lower for price between NQ and ES. Price came up, retraced back to this bearish gap. You could have entered off a breaker block, order block, etc. We entered off a tap on this bearish gap, offering us a valid stop placement of around 20 handles. So if price was to reach up into this upper 1 minute, we would have not been stopped out and the trade would still be valid. And then we targeted the opposing liquidity. We trailed our stops to break even, it took us out, and then it ran to final TP. The past 2 weeks has been a little bit slower than the course of this whole year due to little to no red folder news over the past 2 weeks. That has mainly been the cause of slower price action, which you guys have actually seen. This week we closed out for literally only a 30 handle gain on the week, which was definitely one of the slowest weeks of the year. And last week was a relatively slow week as well. October month is usually actually a good month to trade, but due to the little to no red folder news which has come out over the past few weeks, price action's definitely slowed down a lot and hasn't been as clean. We also have the election coming up within the next 2 to 3 weeks, which could possibly, I don't really know because I'm not the market maker, but I'm just saying the presidential election may have some sort of impact on the markets at the moment as well, maybe causing slower price action. Throughout this whole year, we've not had a losing month this whole year. Every single month this year has been 300 or 500 plus handle months, especially the months of March and April. Absolutely huge months. There is proof of this as well. Many members inside of the group, they've simulated throughout trading the slowest months of July and August. The Excel sheets they've created of all of the past trades that we've taken throughout the whole year, and they've simulated through accounts, and everyone inside of the group is getting funded and paid out consistently. Not only is the money side a great side of things, but they're also learning whilst they're making money as well, learning the level of patience and discipline, which can actually take a lot of new members by surprise because they don't understand how my level of patience is at where it's at, because sometimes we don't take a trade for 4 or 5 days and a few people start to lose their minds, but that's all part of the learning process. Guys, I really hope this video has benefited you in some sort of way. If it has, then drop a like on this video. Let's at least get around 500. Let's aim for 500 likes on this video. Subscribe to the channel. We're on road to 10k and we're aiming to hit 10k by the end of the year. This channel has completely blown up over the last 6 months, so smash up the like button and comment what you want to see inside of the next YouTube video. Any suggestions, I take them into account and put them in my notes as well. And on that note, I will see you guys in the next YouTube video. Have a great rest of your weekend. Don't be